This panel is going to have a slightly different structure in that I've been asked to begin with a slide presentation. And what I've done is pull together a small number of slides so that we have some of the facts and figures out on the table before we begin, if you will, the panel discussion. There are so many important topics, including those that were raised in the previous panel, that we thought it was best to have some of the data available for you. So let me begin. Hopefully this will respond to my touch. Excellent. And I'm going to begin with this particular representation of growth in the US economy. Many of you may not have seen it presented in this way, but these are the sectors in US GDP. It goes back to about 2005. That dark line represents consumption. Now, many of you are aware that personal spending or consumption is, in fact, the single largest category of US GDP. It's more than 2/3. But what we're showing you here are the growth rates. So over the last 10 to 12 years, which are the sectors that have grown the fastest? And you can tell which are the fastest by the slope of the line. The two lines that are at the top are the sectors that have by far grown faster than the others in US GDP and have set the pace. And at the very top, i.e. the fastest single growing sector of US GDP over the last 11 or 12 years has been exports. Now, sometimes that gets lost in the political discussion, but indeed the United States has seen enormous increases in exports during this period of time. By the way, if you're wondering what that vertical line is, about 1/3 of the way into this exhibit, that represents the financial crisis and the severe recession which followed. The second strongest, fastest growing sector of the US economy during this long period of time has been business equipment and software. This has been a category where there has been, in fact, investment by US companies. I would urge you, though, if you have very good eyes, to recognize that over the past 2 years, this sector has been faltering. So despite many, many years of very robust incremental investment in this category of business equipment and software, things are not looking quite so robust over the last couple of years. That dark line again is consumption, and then there are two lines at the bottom. And if you have very good eyes, you'll see that we benchmarked all of these sectors to 100 in 2005, and these two weak lines are below 105, which means throughout this entire multi-year period, they have grown cumulatively 5%, or as the accountants would say, pretty much nil. There has been practically no growth in one category. In fact, if you could see those dashed lines, that represents business structures. There was dramatic overbuilding in a good deal of commercial construction. 10 or 12 years ago, there was excess capacity, and in addition to that, there have been some of the structural changes that were discussed in the last panel. If you have less manufacturing, for example, you don't need as many new factory buildings. And oh, by the way, over the last 5 or 6 years, the average amount of square footage assigned to each office worker in the United States is down 25%. So there are a number of things going on, many of which suggest we don't need the same sort of rapid growth we needed previously in economic activity related to building new stuff. And by the way, that other line on this slide that has barely budged over the last 11 or 12 years is government spending. So again, despite some of the rhetoric that you've heard during the campaign season, government spending has not been an area of significant growth. In fact, much of what we have seen over the last handful of years has been some increases in state and local spending and declines in federal spending. The next slide goes into what has happened with regard to the spending by state and local government, specifically on infrastructure. Those of us who live in New York and enjoy the potholes or enjoy the royal reception at LaGuardia Airport, we understand that there has been notable underinvestment in this category. And the category within public infrastructure spending that has lagged the most over the last several years has been spending, by the way, on education. I want to stress that because one of the things that was mentioned in the last panel, and I believe that Professor Krueger will talk about this more, is that in order for an economy to grow well long term, in order to have sustainable increases in productivity, which gives us sustained increase in standard of living, we've got to do long-term investment. And that long-term investment includes both the K and the L, K meaning capital, L meaning labor, and we have really fallen down on the job in several different aspects here. One way to look at this is something that Bruce Rayner mentioned in the previous panel. This is the unemployment rate in the United States. In aggregate now, it's about 4.6 or 4.7%, and you can see that there are wide variations, and here we're looking at those variations by level of education. Even at the worst part of the severe recession, those who had bachelor's degrees had an unemployment rate on average of about 4% compared to the double digits that were experienced in other categories. Now we have seen that the unemployment rate has declined for all categories of workers when looking at level of education, but the spreads are still wider than they were before the severe recession. And oh, by the way, degree alone doesn't tell you everything. I'm sure we all know young people in our lives, perhaps, who had a fondness for French literature or something else, and they may have a bachelor's degree or a master's or a PhD. They may not be earning quite as much as they had expected. As a nation, we've also flunked on this. In the 1950s and 60s, a period of good productivity growth, one could argue setting the stage for rapid economic activity in the United States, about 1/3 of all college students were getting degrees in what we now refer to as STEM, engineering and applied science, about 1/3. The most recent data suggests that that number is well under 10%. And I would suggest a related problem is as follows. In the 50s, 60s, 70s, and maybe later, college students, by and large, were also required to have a baseline of understanding in mathematics and science, regardless of major. Those requirements have also fallen by the wayside, and I would argue that even among our well-educated people, i.e. those with degrees, we have a large number who are scientifically illiterate, and they are also innumerate. And this, to me, is a danger, not just in terms of their employment, but in terms of the way they think about policies going forward. There's also a variation in employment and employment satisfaction, if you will, and success by industry. Previous panel touched on this briefly as well. I'm just going to call your attention to the bottom line, which is the one sector which is showing even more structural difficulty than was mentioned previously, and this is retail workers. The average retail worker in the United States today, despite good economic activity, despite that big increase in consumption spending that I showed you early on, those individuals are working under 30 hours a week. And this is a decline in recent years. Part of this is the change, the structural change in the way we spend our money. We buy things through e-tailers. When I buy my Casabella sponges, I buy them online. By the way, it's a fabulous product. I can't say anything about the broom. That's not in my category of home care. but the sponges, and we actually own many of those products. We buy things online, as I'm sure many of you do. And what we see is that retail workers, now working under 30 hours a week, they're not earning very much on an hourly basis, and many of them not receiving benefits either. Add on to that some of the questions for other categories of workers who sometimes will refer to themselves as consultants or freelancers or the gig economy. These are categories of workers who are also in many ways feeling disaffected because they have not seen the commensurate rise in their comp over the last several years. Now, I mentioned before that to get good long-term sustainable economic growth, you need long-term investment. And here we're looking at R&D expenditure for a number of countries. Basic research, which the US government has funded going back to, I believe, roughly the 1820s or 1830s. In the post-World War II period, was about 4.5% of GDP. Let me be clear, if you added up basic research and R&D, including some from corporate, that was about 4.5% of GDP. And again, this was coincident with a period of good productivity growth in the US economy. We're now down to 2.5%. And we are no longer the leading country in the world on this basis, as we were for more than a century. For the last 15 years or so, we have been moving lower and lower. On this particular slide, you'll see that some of those Scandinavian nations that really are focusing in on enhancing value add for their workers, they outrank us in this category, as do nations like Korea and Israel. The United States is now at the bottom of the top third. The other thing where we are not doing as well as we used to is researchers in science and technology, this kind of capital, the human capital. The United States, as many of you know, has the world's single best tertiary system of education. Roughly 2/3, and in some cases 3/4, of our PhD candidates in engineering and applied science are non-US citizens. In years past, they wanted to stay, and they helped create economic growth and innovation in the United States. Now, for a variety of reasons, many of them are going back home. And when we take a look at science and technology researchers in the United States, and here we're scaling it by the size of our workforce. Obviously, we have many scientists and many engineers, but let's scale it relative to how many workers we have overall. We used to be number one for a long, long time. We're now sort of in the middle of the pack. I would argue that's not where we want to be. All of that's so upsetting, isn't it? So I wanted to show you something I think is a little bit humorous. There are two well-known surveys out there that measure innovation, that measure how different countries are doing competitively on this basis. And in this particular survey, which is a combination of INSEAD in Europe, Cornell in the United States, they are looking at 141 countries. They have about 100 different factors that they believe contribute to innovation. By the way, I don't agree with them on all of them, but it's a fun thing to look at. What we're comparing here are just two countries, China and the United States. By the way, in terms of the overall score, they believe, that is the authors of the study, that China is the 29th most innovative nation on the planet, the United States number 5. Well, what are some of the categories contributing to innovation? If you take a look at general infrastructure spending, China's ranked number 3, the United States number 15. On the other hand, environmental performance, out of 141 countries, China is ranked 102. United States, not as good as we should be. We're at number 33. But where do we excel? We are ranked number 1 in the world on market sophistication. Not a surprise. People in this room don't need to be reminded of that. But I would call your attention to the bottom line as well. For some reason, the authors of this study believe that adding up video uploads on YouTube is a measure of innovation. And when I asked the author, the lead author of this, why did he view that as a positive, he said, well, it's a sharing of information and TED Talks and so on. And I said, it's also cats dancing. The United States is ranked #1 on YouTube uploads. I happen to think it's mainly Stephen Colbert the last few weeks. And China doesn't allow video uploads, so that's an NA. This is the other main survey of innovation in the world. This is done by the World Economic Forum. I don't believe a lot of their data either, but I would suggest to you that on this spectrum of countries, at the top, at the Northeast quadrant, you're seeing countries that are focusing on economic growth through high value add. Education, innovation, basic research, trying to distinguish themselves in those regards. And in the Southwest quadrant, countries that have been trying to grow through low cost. The fascinating thing is as follows. These are the most recent data published not long ago, 2016, 2017. If I could superimpose the data from a decade ago, you would see something phenomenal. At the very bottom in that Southwest quadrant would have been countries like Brazil, India, China, South Korea, and so on. Most, but not all of them, have moved up that scale. They've moved up the spectrum as they have been investing heavily in research and education and so on. And what I find fascinating, and this relates to the trade discussion a little while ago, for many countries, it's no longer low cost. It's a question of competing on the basis of knowledge and value add. And I'm going to finish with the following topic. Companies, right? Companies represented in this room. What are companies doing in terms of investing in the future? We take a look, for example, at the president's recently proposed budget. By the way, it's not really a budget because there's no revenue in it. It's just a list of spending priorities. And we take a look and say, oops, basic research doesn't look very good there. So corporations in some industries make up some of the difference, not all of it. This is a look at cash generation for the companies in the S&P 500 going back to 1999. And you can see that with the exception of that severe recession in 99-2000, by the way, we have a nice pattern of growth in corporate cash flow during this period of time, okay? The important thing here, though, is not that corporate cash has been rising. We know that. The economy has been growing since the summer of 2009. What is important here is how that cash is allocated, okay? If you go back to 1999, 2000, 2001, roughly 70% of the cash was allocated for growth. Some of it was cash acquisitions, which makes people in this room happy. Some of it is CapEx. Some of it is R&D, okay? So it used to be about 70%. It's now 53%. 53%, a very sharp decline in the amount of money allocated for growth. The increase has been going instead to what? Share repurchase and increased dividends. Now, there are roles and purposes for that as well, but I want to point this out. So when we have conversations about corporate tax reform and say we want to enhance corporate earnings and corporate cash flow, it's not just a question of raising cash flow, but what's that money going to be allocated to? And that's the part of corporate tax reform where there has been precious little discussion, at least thus far. And finally, tax rates. Yes, the United States has the world's highest statutory tax rate. If you add in the 35% federal rate plus the, let's call it average 4% state corporate tax rates in the United States, 39% statutory sounds high. For the S&P 500, the effective average rate is actually below 30%. And when I spoke in preparation for today's talk to our analysts based in Washington just yesterday, about, so what is he hearing about what the corporate tax rate is likely to go down to? He's saying that the Republican caucus believes that they can get it down to about 28. On average, that's not much of a change, but if you're lowering the statutory rate notably, how do you do that? You do it by getting rid of any number of credits and other preferences. So when we talk about corporate tax reform, it really depends upon which company, which industry, and which benefit do corporations take advantage of now that may in fact disappear. And with that, I'm going to stop talking. I thank everybody for giving me this opportunity to basically, I was going to say set the table, but I'll just say set the stage, because we're sitting on a stage.
I really appreciate that. That was a great presentation. And I think the main question that it raises for me is really what's to be done. How do you build an incentive system, since everything is sort of up in the air, that will incentivize this sort of investment that will lead to higher growth? And I'd be happy to hear from all of you guys on this, because I think you all have very directed expertise, but all in that sort of area. So Alan, do you want to get us started?
Why don't I start, because I think
Sure.
Abby did set the stage very well for what I wanted to cover. Economic growth is not too hard to understand. It depends upon two key things: productivity growth, which is output per hour, and the total number of hours worked. Really simple equation. And those two components, which I think about in terms of productivity growth and labor force, the size of the labor force, I think there are many reasons to think both are going to grow very slowly going forward, slower than we've seen in the past. Let me start with productivity growth, which is sort of where Abby ended up. Productivity growth has been very difficult for economists to predict. We didn't see the productivity growth slowdown coming in the 70s, and other than Alan Greenspan, we didn't see the speed up coming in the late 90s. Productivity growth was over 2% from 1996 to 2006. And over the last decade, it's been under 1%. Over the last few years, it's been below 0.5%. Now, this is a worldwide phenomenon. I don't think you could say this has to do with regulatory policy in the US, because the productivity growth slowdown has been stronger in Europe than it has been in the US. Also, although it's tempting to believe it's a measurement problem, the evidence suggests that we've always have had measurement problems in output. There's no reason to think that they're worse today than they were before. I'd be happy to go into more detail on that. So then if we take the numbers at face value, what they suggest is that productivity growth has slowed down partly because capital investment slowed down so much, which you can imagine is a legacy of the financial crisis, and that can turn around. The second factor is a slowdown in total factor productivity, which is the innovation part. It's using existing set of resources more efficiently. It's developing new products at a faster rate than we have been before. That is sort of the mystery in terms of productivity, which depends very heavily on research and development. Interestingly, in the US, the education component has not slowed down. We've shifted more to private education, Trump University. You could question the quality adjustment of education. But at least if we look at years of schooling, that's not been a factor in the productivity growth slowdown. To me, the most worrisome part is total factor productivity growth. How do we become more innovative, especially given that other countries have realized our secret, which was education, research, and development. And I share Abby's pessimism, particularly when it comes to fundamental research, which is where the private market fails. There's no reason for companies to invest heavily in fundamental research, because that's a public good that's used by other companies, so they would underinvest. Let me briefly say about labor force. The other term in the equation here is how many people we have working, how many hours they work, what's the participation rate. And here there are reasons for pessimism for the US going forward. Population growth is slowing down, particularly among working age people. In the 1980s, the population aged 25 to 54, prime working age, grew by over 2% a year. Over the last decade, that has increased by 0.1% a year. Going forward, it's going to be pretty stagnant. Then if you look at labor force participation rate, the share of those working age or other groups who are working, that has been declining since 2000. There are many reasons for the decline in labor force participation. Most fundamentally is women fueled the rise in participation in the US in the post-war period, but they stopped adding to the labor force, or at least at a higher rate, in 2000. And since 2000, labor force participation rates have been declining for women as they have for men, and across a broad spectrum of women, not only women with low education and fewer job opportunities, but also very well-educated women. So I think the reasons behind that are complex. If you look at men, the male labor force participation rate has been declining in the US since the end of World War II. I did a study last fall where I found that half of the men aged 25 to 54 who are out of the labor force are taking pain medication on a daily basis. 2/3 of them are taking prescription medication. And I think this is connected to the opioid epidemic, which is affecting the US. I don't think that's going to be very easy to turn around unless we focus on that problem. Also, labor force participation does not tend to be very cyclical. It's very hard for a strong economy to bring more people back to the labor force. That's one reason why, as Joe mentioned earlier, we see wages tend to grow when the economy is overheated or growing at a fast rate. It's in part because the supply side doesn't respond on the labor market side, so wages grow. And then the last component, which has been fueling our growth in labor force, is immigration. And it's hard to be optimistic, at least for the next 4 years, that we're going to see a friendlier immigration policy than we've seen before. So the upshot of this for the business community is we're headed towards a labor shortage. I think this will help address some of the problems that we've seen with stagnant wage growth, but I think it also means that the business community needs to adapt to this new environment. And if you put the two sides of the equation together, it means much slower GDP growth. It's very hard to see how GDP growth is significantly above 2%. If labor force growth is at most 1/2, and if productivity growth recovers the way CBO expects to 1.7% a year, which I think is optimistic, you're still beneath 2% growth. And I think that has many implications going forward. It's going to affect, obviously, our living standards. It's going to affect the budget deficit. It's going to affect our ability to channel so many of our resources to national defense. And to my mind, the margin where we're most likely to be effective in terms of raising productivity or raising output is in innovation, investing more in innovation, and then immigration.
That's still sort of grim though, right? I mean, if we're looking at sort of where we are now, and if there is any appetite whatsoever, which is, that's sort of questionable, for policy change. I mean, if you could just make, a corporate tax policy right now out of nothing, that would, incentivize capital investment or labor investment, just these sorts of investments that haven't really gotten much of like you had said before, capital investment after the crisis, I mean, it's understandable that businesses are investing less. But at the same time, aren't there any steps that we could take, policy-wise, to sort of promote that kind of thing? And I think Edward and MA could probably talk a little bit about what companies try to do, I guess, or what companies respond to in terms of investment and where they direct their money.
It's interesting, Abby, when I looked at some of the countries that were on your slides on R&D investment and where they were spending, and there was a couple of countries that popped out. Ireland on one and Switzerland was on another. And it wasn't that they were top, but they were higher than, well, I can say it coming from a Swiss institution and having Irish immigrant parents where you'd expect. There are things, and if you look at the two most active segments of the M&A market in terms of the number of transactions, not overall deal value, are tech and healthcare. And if you look at one of the things that was talked about in the last panel was tax reform. There's been an element, and it was particularly important in the M&A, peak year of M&A of 2015, was inversion transactions. And you had a situation where you had M&A activity being driven by the fact that people were trying to change their corporate domicile to save significantly on their corporate tax rates. But the companies that were doing that, and these are now the companies that have tracked cash overseas, were predominantly pharmaceutical and tech. And inversion by itself didn't do anything. Earnings stripping after that did it, and the way that you would strip earning is you would move IP overseas. For a lot of those countries where you move the IP to, they wanted you to move the jobs as well. And so when I look at it, it's difficult when you say, well, you're an M&A banker, you're talking about growth, you're talking about sort of policy change. But there are aspects of what we do and what we see in some of the more innovative sectors where we see tax or we see structural techniques within M&A. And a lot of times, again, M&A, you could say, well, you do M&A because you've failed in R&D or you do an M&A, but a lot of times in those two sectors, an M&A at least accelerates the commercialization of R&D, brings it quicker to market or through better distribution. But what they've also done is they've incentivized some large companies to keep fundamental research sort of outside the US because of the tax incentives. And I think, in that one aspect, if you could think about how to address that, I'm not saying if you have a cash repatriation holiday and it brings everything back to the US that it's purely going to be done for investment in CapEx or fundamental R&D or an M&A. There'll be some capital return. But there's some structural perverse incentives that are driven by financial aspects of transactions and deals that affect the way that you think about R&D and the way you think about some of the things that structurally affect longer term growth.
Right, so would that involve just global taxation, switching from a territorial to global? Would that sort of close that particular loophole? Or would it be a wholesale restructuring of the incentives?
It would. It would more have to do with global taxation. If you're going to have the ability to keep cash overseas in a foreign subsidiary or change your subsidiary and pay lower tax rates, then you're going to have the tax, the trapped cash problem as opposed to just paying lower tax rates. But again, the element here is countries that became inversion sort of havens linked those lower tax rates to science and technology. You could, as long as you put jobs in those areas, you could pay lower taxes on the royalties, intercompany royalties, to shift cash flow overseas. And attacking that type of structure, whether you do it on making the U.S. more competitive in its tax rate to avoid that, or by dropping sort of global taxation to take away some of the incentives they're doing it, you can not fundamentally, but you will address some of the loopholes that have been used that other countries have tied to R&D and IP and therefore generated trapped cash, and offset that and bring that back.
Abby, do you want to chime in?
Yeah, very quickly, and I don't think and by the way, I agree very strongly with those comments, and I don't think you can fix this with a tax holiday.
Yeah.
The last time there was a tax holiday, if you track the CapEx in the United States, it rose more than you might have expected, and then it dissipated. So over a 2 to 3 year average, it didn't even show up in the data. So I think we have to be careful not to do something that would be a one-time wonder. And if it is a one-time wonder, we have to do something to make sure that some of that money gets captured for maybe jobs retraining or something else that we be supportive of economic growth.
Yeah, go ahead.
I think the other thing about tax is it's one of the areas where you can get really quick change. And I'm no economist and heavily outnumbered by economists, but it's always seemed to me that very quick change usually has some very unpredictable effects. So you have a long discussion going on about BEPS, which you can have your own view on, but sounds to me fundamentally sensible. And then you have the EU coming in and applying state aid in a way people aren't expecting to impose a very significant tax charge. What's going to be the effect of that? And we've had some other ones like inversions. That was just a distortion, frankly, and it comes to a shuddering halt. And you think, well, hang on a minute, what was going on before which was so good and which has now been stopped? Or was it not so good and it's now been stopped? But anyway, you've got a dislocation. And if you look more broadly as I look forward, it's the dislocations which worry me more than things which are just happening slowly. And I think there are quite a lot of those out there. And at the moment, markets seem to be moving on the basis that none of them is going to have a sudden major effect. But I think the next year, 2 years, is going to be heavily influenced by whether markets are right or whether actually we find that some of those triggers which could go off turn out to be more significant.
What are those dislocations?
Well, Brexit's a good example.
Right.
North Korea doesn't sound to me wholly comfortable,
Yes.
and so on.
Okay. And Alan, do you want to chime in as well, just on the policy?
You know, I think there are many things we can do to improve our tax system. I don't count on the Congress doing them. One of the things I learned from the 4 years I worked in the Obama administration is not to let the best be the enemy of the good. But I think corporate tax reform or tax reform, I think doing comprehensive tax reform makes it even much harder. But even if it's just corporate tax reform, I think it's going to be harder than the healthcare reform was. So I wouldn't be at all surprised if Congress gets tied up in knots. And Abby's comment was very interesting about bringing the top rate down to 28%. That's about the best you can do if you have revenue neutral corporate tax reform and you get rid of all of the preferences. Now, it's inconceivable to me that we're going to get rid of all the preferences because they're all there for a reason. So then the question is, how much of an impact does it have on the deficit, which could be sizable? Or maybe the rate doesn't come down even as low as 28%, which I think would be viewed as a big disappointment by markets.
Yeah, and speaking of markets, we have had a pretty significant rally, and we haven't had too much of a, we've had a little bit of a sell-off. It looks like the Trump trade is slowing down a little bit. But I had to ask, Abby, what do you think about stock market valuations right now?
You're curious.
What's curious about them?
Well, first of all, the way I like to look at equity valuation or fixed income valuation for that matter is to start with the economic fundamentals and then to move into the specifics of that security. So for example, in the equity market, the idea that prospective growth is looking good, and by that I don't mean it's going to be rip-roaringly strong, but it will be extended. If inflation does not become problematic, and we don't think it will, we expect it to drift up, not gallop, then we can see ongoing growth in GDP and earnings for 2017, 2018, maybe beyond. And I think that this has been one of the main reasons that the US equity market has performed well over the last period of, let's call it the last few months. But even there have been two phases, and I'm going to say something just to be a little controversial. In the first part of the so-called Trump trade, in my view, it wasn't really a reflation trade as many people presented it, but rather oh gee, we're going to get rid of some regulation, and that's going to be good for financial services, and that's going to be good, I'll say, for polluters, right? And so a lot of those companies did extremely well. What we're seeing now are companies that are performing well in the equity market because they've got really robust profit growth, really robust revenue growth, and their prospective growth rates look good. So a lot of that, by the way, again, is financial services, because financial services are highly correlated to how well the economy is doing. It's related to technology and so on. So what could unsettle this? When we look at the underlying dynamic, it looks okay. It's not the most attractive valuation I've ever seen, that's for sure. I'm much more dramatically concerned about valuation in the bond market than I am the equity market. If you look at 10-year government bond yields around the world, there's not one country where we believe the 10-year bond is appropriately priced. We think that yields are too low and bond prices are too high almost everywhere. That to me is in some ways more disturbing than the equity market. But the equity market, to the point that Alan was mentioning before, always has expectations. The expectation that policy will be good, the expectation that things will be calm and so on. And any investor knows that that's rarely the situation. You know, we build our models and there are modest changes, small incremental changes, when in reality things swing in a very significant manner. We are concerned about how will investors respond if there is some sort of crisis, be it domestic or international, and this administration is not able to respond in a good way. And by the way, I'd be saying that regardless of whatever administration is in place. But when valuations are don't give you much margin for error, that's when you have the higher risk content. If I could make one other observation, and that is we look at volatility in a number of different ways. There has been really very little market volatility using the standard measures like the VIX and standard deviations of price change and so on. Where there has been enormous volatility, and these are relatively new measures, are things that we would call policy risk measures. And we are looking at these not just in the United States, but also in the UK, France, Germany. You can fill in the blank for a lot of the other countries, and these are at very high levels right now. And so we become concerned about what abrupt changes, disappointments, surprises in these categories of government policy might mean for financial markets.
And so taking that picture with low interest rates, narrow corporate credit spreads, and relatively high equity valuations, I'd be curious to hear what that might mean for the M&A situation in 2018, if Emma and Edward could talk about it, because everything's expensive, right? I mean, where do people start looking?
Yeah, I mean, rates are going up, but rates are still incredibly low. I mean, if you're talking, and one of Abby's slides shows cash acquisitions, if you had looked over the last 3 or 4 years, the component of all cash consideration has just been really gone up year over year. If you take out those inversion deals in 2015, where structurally you had to use some stock, you're sitting there in the, you know, the 60, 70%. And then you have another bucket, which is cash and equity, and then you'd have some equity deals in there. People that do MOEs or deals that want to punch up as mergers. And so the ability to make a deal EPS, you know, accretive, given where interest rates are, that is not going to go away, you know, into 2018. That, you know, will be there. It will incrementally get tougher, okay? I think, you know, the challenge again will be, you know, people really want to see M&A transactions for growth. You know, if you're doing M&A transactions to take cost out, you're making yourself a bigger, slower growing company just for, you know, a step function of synergies. That will have a downward effect. I'm a little bit concerned about what the impact of volatility is, because as we get into the equity markets, even though you could say, well, equity isn't, you know, being used as a source of financing, volatility, it's just a risk metric. And if you're concerned about your own share price, you're not, because of volatility, you're not going to take on M&A execution risk and up, you know, that as well. It's more, it's not a direct impact, but it's an indirect impact on M&A sort of psychology and risk taking within the boardroom and within the C-suite. The second thing that it's a bit more, it's not, I would say, concerning, but it's a wild card, is if you look at the proportion of cross-border M&A, particularly in the way that it's grown over the last couple of years. We had the China outbound activity starting in 15, that got reined in 16. There's probably a pretty good chance that that'll come back at the end of this year. Into Europe right now is very hot. If you start talking about protectionism, and you start talking about particularly antitrust approvals as a way to, you know, get back at people when you're talking about multinational deals, you know, in my business, because a lot of it is cross-border, that could have a significant impact as well as the overall M&A market. It could get a little easier in the US. If you look at right now, if you look at the recent regulatory approvals, there's antitrust, but there's also things like CFIUS. CFIUS could get worse. Antitrust in the US could get easier and better. It's just, I think everyone would agree, it's probably a more business pro administration right now. And so US M&A activity, 2017, 2018, we feel pretty good about. Global M&A activity and how it's been affected over the last couple of years by particularly cross-border transactions, we're a little bit concerned.
So following through on that, even within domestic US activity, you have some which is really pure US, and you have some where there is some or all of the company which is held around the world. Almost anything which is held around the world is going to trigger the same antitrust issues that you were touching on there. And if a theme around M&A, it's that as the various things have come along which have made life more difficult, the need for preparing well and really trying to think through how different countries are going to view whatever you're up to, and then try and take account of that. All of that has become more and more important in recent years, and I think the recent moves, particularly around antitrust, but it's around almost any regulatory approval around the world, which has tended to be a little bit more nationalistic in approach, where the convergence we've seen that you should fundamentally look at the economics. People are looking at it in different ways, and you've got to understand that and try and plan it up front.
Do you expect antitrust approvals to get easier as well? Because it seems like, at least from my perspective, that could be also an issue with the Trump administration. People have been talking about concentration risk in multiple markets at this point.
I mean, people often say that in the US it will, but if you look at it around the world, I don't see that following.
Okay.
And I think we're going to see more examples where, for instance, things get blocked in Europe but allowed in the States, and in part because actually they're looking at it in two different ways. And you're going to have to manage the two probably more skillfully than we've had to in recent years.
Right. And what do you make of that, Alan? Looks like you.
Well, I would defer to Fresh Fields on antitrust.
Great.
I don't know. I suspect if there's a general direction for antitrust, it will become easier.
Okay. And so I actually got a really interesting question here from the audience, and I know we might end up moving to more of these later on. But so far we have been talking mostly about the big multinational global corporations. And is there any way to sort of depict, I guess, what's been happening in markets lately as a shift from large corporations to small, or any sort of showing of interest, I guess, from the administration of doing that?
Yeah, I mean, one of the things that is actually a positive sign for professional investors is that we are seeing this divergence within markets. In the period immediately after the financial crisis, there was very high correlation among global markets and within markets. And so correlations between markets around the world that previously might have been a 0.3 or a 0.4 rose to about a 0.9 or a 0.95. And within markets, there was also a very narrow divergence of performance. What we have seen more recently has been that share price performance, and by the way, also performance of corporate bonds, has been much more related to the performance of the underlying fill-in-the-blank country, industry, issuer. And that's good news. I mean, if you are a professional investor, the last few years haven't been all that happy because the indices did very well. And anyone who tried to be an active manager, in many cases, was not able to add value. Instead, that has changed very dramatically in recent months. One of those categories is, in fact, small versus large. Investors are more willing than they had been before to look at small and mid-cap sized companies. Part of that has to do with this, by the way. In the early stages of economic recovery, regional banks weren't lending. Large multinational companies had no problem getting financing because they could go to the global capital markets, be they equity or fixed income. So it's really only the last 2 to 3 years that those regional banks that cater to the small or mid-sized cities in the United States were getting more active in providing capital. So that's one thing that we see. The other thing that we see that I know many people have commented on, including your publication, has been an increased willingness for capital flows to leave the developed markets and to go back to some of the markets of the emerging economies, that's a sign of increased risk appetite, number one. But number two, it's also a sign of belief that a number of those economies are now, in fact, performing a little bit better. And for them, by the way, the political risk in the developed economies is quite significant, because if there were to be notable changes in trade policy, the emerging economies would be notably affected. And also keep in mind that the United States is a very significant customer for whatever is produced in those other nations. By the way, as is Europe, but it's important for everyone to recognize, as was pointed out in that earlier panel, we're all connected. It's very hard to analyze one country or one market in a vacuum.
I think just picking up on that point of connected, and sort of moving back to the larger companies, I think there are two trends I see. One of them is major American corporations who are increasingly thinking about raising capital outside the US and tapping into wherever the liquidity is. And the other way around, just about every European financing stays fluid as to whether it's going to be tapping the US market or the European market until very, very late in the day. And increasingly, everyone involved needs to be very agnostic about where it winds up.
Yeah, the US doesn't have negative interest rates.
Probably helps.
I think that's a very important question because about half of workers in the U.S. work for small companies. They're not traded. They're not incorporated. They're not going to be affected by corporate tax reform. And I don't think there's been enough discussion about what can be done to help that sector. And this has been an unusual period because ordinarily small companies lead the way out of a recession. But because of the nature of the last recession, as Abby mentioned, because banks weren't lending and because small businesses had their credit decimated, they couldn't borrow on their house, they couldn't take out credit cards to start new businesses, small business really suffered in the recovery. And it was an unusual recovery in that we saw more growth from the larger companies. To see this recovery really continue and pick up a notch, I think it would require small businesses. And maybe some of the regulatory reform will affect that, not so sure. I think we could do a lot of tax simplification for small businesses, and they also have large non-compliance issues when it comes to taxes. But that's not an area where really either party has focused enough attention.
And I'd say just I'm going to bring it back to innovation, and we talk about volatility. You look at certain industries, and I'll go back to either biotech or tech. The innovation really comes through the small companies, and it's access to the equity capital markets, the VC market. But as you get into a very healthy IPO market and equity market, you get earlier and earlier stage companies coming out. And you find that you're able to have those companies, even though you could say in aggregate the risk, say biotech, the clinical risk of getting somewhere over is the same as if it happened in a big company. You have these situations where you have investors willing to take multiple bets and have a pool of different risk, and one of those companies will succeed, and then it will be acquired, as opposed to a large company, like for example, look at what happened to BMS last year. They lost 20% of their market cap. That's $20 billion on a clinical failure. Now they have Carl Icahn as a major shareholder. You can see, when you think about the way that certain elements of innovation in very innovative industries are funded early on by equity capital markets, and whether it's the private VC markets or the public markets, remember the private markets are thinking about that public exit. As that volatility comes back up, it could have a negative effect in near term on some of the way that innovative companies are funded. And they're the ones that, I wouldn't say they're less risk adverse, but there's the ability for them to take on a little bit more commercialization or clinical risk in those two key sectors.
And how do you see the concentration, I guess, in your industry and healthcare specifically, I guess, compared to history? Because in a lot of areas like finance and a lot of other, bigger company-led, I guess, sectors, people have been talking a lot about concentration risk and sort of the negative effects that it has on the whole economy. But it seems like healthcare, and especially the biotech boom, might be an exception. But I'm just wondering if, relative to history, if it's gotten more or less concentrated.
It's tough because you can talk about healthcare broadly if you look at the entire services side. And we've had a consolidation in managed care, which we had 2 major transactions. One has been dropped. The other one is, although still pending, looks like it's going to be dropped. There, when you look at on the services side, the desire to take cost out of the equation, concentration can be argued as a good thing. You've seen the pharmacy benefit management subsector, really be consolidated because it takes cost out. On biotech, on med tech, on diagnostic, there is a concern on the innovation side that if you concentrate use too much, you're going to get less innovation. There, again, I don't think that it's as much a risk because the big companies are willing to let the little companies do that. And once they get beyond the clinical risk, they will still pay an extraordinary amount for them. We talk to major acquirers all the time, and we'll say to them, well, if you took somewhat of a clinical risk and bought this company as it's getting closer but on the way, you'd save yourself hundreds of millions and billions of dollars. And they say, yeah, I know, but I'd lose my job if it failed. And so I will pay a couple billion more once it gets over that hump. So they're letting them innovate and do that innovation out at risk, really where it comes down to commercialization. So I don't see, in that one sector, I actually think that because it doesn't inhibit the innovative part of healthcare, and actually concentration is arguably needed on the services side, on the cost side of healthcare, it's not as big a risk.
Here are some numbers to puzzle over. In pharmaceuticals, it takes about $1 billion, with a B, dollars to get something through R&D, through the FDA approval process, and to the market, $1 billion. Only about 10% of all drug innovations are successful. And we need to ask ourselves, can only large companies handle that kind of risk? So that's one thing for us to ponder. The other thing for us to ponder is that the National Institutes of Health has been a very significant provider since the 19th century through its predecessor organizations for basic research in the biological sciences. And the current budget for NIH is the lowest we've seen. I'm going to get this wrong. It's either the last 10 years or 20 years. Let's say the last 15, all right? It's pretty low. And then the budget proposal, those priorities listed by the new administration would cut that, I believe, another 30%. And so much of the basic research, which helps fund some of that risky, innovative things, which, as Alan referred to before, really is the common good, a lot of that funding may be disappearing, even in pharmaceuticals.
So now on that upbeat note, we find ourselves back on policy, and thanks so much for staying with us, guys. I know it's getting late and it's a really nice day out. But I think that the policy risks that we could talk about here are sort of have been the topic of the day, or going to be the topic of the next few months. And we have a lot of questions from the audience about, what do you guys see as the biggest policy risk for 2018 and for the remainder of this year? So Alan, I don't know if you'd want to get us started with that.
We have a new administration that seems to want to disrupt things, which doesn't have much experience governing, combined with single-party control of the Congress, but not clear that it's a functional majority. So I think the economic policy environment is a lot like it was in 2013, 2012, 2011, where just doing the basic fundamental roles of government, raising the debt ceiling, which is an absurd constraint. I said when I sat at the Treasury and then at the White House that the debt ceiling makes absolutely no sense, and I think it's going to be a big risk for the Trump administration, how they're going to figure out how to raise it. And then, the basic spending, the core things that government does, I think are going to be a challenge. And if tax reform goes the way of healthcare reform, if infrastructure goes the way of healthcare reform, I think that's what we're left with, facing those challenges. I think there's underlying momentum in the economy still. This recovery has been different than many recoveries in that we were very slow in some of the cyclical sectors, especially housing, There's still room for housing to expand. Maybe we've worked off the excess in the structures. That would be nice, would give some additional boost. Consumers are in a much better position now. They're not nearly as leveraged as they were, say, in 2007. So I think this recovery can keep going. I told President Obama many times this is not going to be the strongest recovery ever, but it could well be the longest. And I think that's possible. I think there's a lot of economic policy uncertainty. It's a question in my mind how much it matters. I mean, companies used to tell us all the time, if you can just work out a budget deal, there's so much uncertainty. If you don't work out the budget deal, everything will freeze. You know, we continued growing at 2.25%. And I think there's much more uncertainty now than there was in 2013. That could potentially slow investment. But I think if we just have kind of predictable economic policy, this could very well be the longest recovery that we've had. And that's necessary but not sufficient for solving our problems. You know, if you think about income inequality or some of the other problems that we face, it certainly will help if we continue to see the unemployment rate drop, and that'll tighten the labor market, pick up wages.
I guess I should say something about Brexit. So maybe start from the inherent uncertainty. I don't think there's anyone in business who would have launched a deal with this degree of uncertainty as to outcome. As we watch what happens, I think I keep in the back of mind that the European Union has a long track record of managing through really quite serious negotiations. There is a track record of being very clever in how they look at the powers they've got, and there is a long track record of doing things which are not illegal, but they aren't necessarily what you'd have thought of as strictly written down. So one way or another, don't get too swayed just because there's a bad news day. I think this is one to keep a broader perspective on expecting something to come out of it. I think the mood has changed very significantly. If we were having this discussion shortly before Christmas, I think you'd have found me in a pretty depressed mood because everyone was behaving in a way which was utterly unconducive to reaching any sensible outcome. I think if you look through what's been said over the last 2 or 3 weeks, there's been a huge effort to establish more of a mood in which you can achieve a sensible negotiation. And I think that is on both sides of the channel. And I think people are thinking, particularly on the UK side, people are thinking in the way that you need to think in order to get things done. So, you know, it's politically too difficult, it's too expensive. You know, things which are in those boxes are very much being pursued actively. I think from a business point of view, probably the thing which everyone can do, which will be most helpful from all, is to get through to the politicians why it matters to you that a particular outcome is achieved. Because if politicians across Europe get a consistent message that actually business needs an outcome which works for everyone, then that's the sort of thing which will actually get us to where we all need to get to. If you think you've made the point, I would make it again and again and again, because it's only by repeating the messages that the politicians really hear it, and there is more that is needed. And I'm going to finish by saying that I think overall I'm an optimist. I think it'll be a rocky patch between here and there, but I do think that at the end of the day, these economies are too big to disrupt, and if politicians want to get voted back in, they're going to have to do something which allows business to carry on more or less as it has been. There'll be changes, for sure, but I think there'll be more at the edge than at the heart, which is what's been threatened from time to time. So overall, I'm an optimist.
Okay. Abby?
This is such a broad area. You know, what could go wrong in policy? It's hard to sound thoughtful in a very brief period of time. So let me give you a couple of examples of things I'm concerned about, specific things. Number one, border adjustment tax. I view this as something that is a consumption tax. It's targeted at low to middle income Americans. It's highly regressive, and I think it will prove to be not just inflationary, but I also think it could dampen economic activity. The second specific thing is healthcare reform, which seems to be coming back. And in the version the two versions that were introduced a couple of weeks ago, and the new version that is still under wraps in Washington, a very key element of it is to dramatically reduce the number of people who are covered. It's referred to as they still have access, but they can't afford it. So the estimates from the CBO were something on the order of 24 million people or more would lose coverage. I view this as well as something that strikes at the heart of income equality and worsens income inequality in the United States, because it's not just how much you have coming in, but also your standard of living. And if a very large percentage of a family's budget needs to be allocated to health care because they don't have good insurance coverage, that's something that concerns me. By the way, that is also inflationary. One of the things that has held healthcare costs down over the last 2 or 3 years has been the access people have had, the real access and coverage to good quality primary care. We have seen a dramatic reduction in the number of uninsured people presenting at emergency rooms for the first time they're seeing a physician for an illness. So for example, just a rule of thumb, somebody who goes into an ER with an asthma attack, had they gone to a primary care physician 2 or 3 days before, the cost of treatment, including the personnel cost, the medication and so on, is about 1/10 as much. And so I think one of the things we need to keep in mind is just by reducing the number of people who are covered doesn't lower healthcare inflation. It is also, in my view, very likely to raise healthcare inflation for everyone.
It reminds me of the stat that I found the other day about the OECD countries and sort of access to finance and banking and stuff. And the only real way in which American lower income people had less coverage and access to the financial system than the rest of the OECD was people who said that they could get a lot of money if they needed it in a pinch, basically. And you think about the sort of things that people would need, a significant amount of money for in a pinch, and it's healthcare, especially here in the U.S. So I think that's a really important point. And if you want to close this out, M.A.?
No, I would say I'll be very quick because I know we're on double zeros, but I think I said, my concern is on volatility. I think one of the speakers talked about sort of particularly near-term quick volatility, and I would agree with Abby with respect to the border tax. Just, that coming in, just given the era of free trade that precedes us and how quickly things would have to change, I think would be a pretty big whipsaw for a lot of corporates that would be difficult to adjust to, and just a sense of volatility going on there. I would also say just on healthcare reform, I think it's important. I think that the fundamental forces on healthcare, on costs, and on price visibility, those kind of will be addressed regardless of the payment mechanism. And so I hope we can get through the payment mechanism, because when I look at it, you look at Europe, for example, you have single-payer environments where care is rationed. Here, I don't think you're ever going to come to that, but if you're not going to, you have to give people access to what the actual cost is. The emergency room is a great example of where if people, we've dealt with plans where people who have been under pensions or government-funded healthcare, and they've taken ambulances to emergency rooms where those plans are turned over to clinics where they had regular bus schedules, and it dropped the cost enormously. In a lot of healthcare, 70 to 60% is about the facility. And so directing people to the right care, we're never going to be able to have that level of care coordination, so there's going to have to be some visibility, and so it's going to need to be a balance between people being able to afford it, but while at the same time people being able to see the price decisions or else they're always going to go with where the easy access is, and that might not be the best cost or quality of care.
And the people, by the way, who show up at the ER and they're paying 10 times as much, they're not paying.
Yeah.
It's everybody else who has insurance coverage who is picking up the cost.
Well, thanks so much, guys. And I think that was pretty much all the time we had. But the audience questions were wonderful. Our panelists were wonderful. And if you guys could give them a big thank you, that would be great.